The basic idea about this is pretty simple. Momentum usually leads volatility. It makes a lot of sense when you think about it logically, because price action obviously triggers volatility expectations. But when you look at it this way, visually, it's really, really helpful and useful. Now, what I like most about stuff like this is that it's so incredibly simple. It almost feels like it can't be useful in a sense. But if we look at the biggest sell-offs after the recent bear market rally that we had in March, if we take a look at these subsequent sell-offs, each one of the biggest sell-offs that we've had were actually signaled by a breakdown in momentum, which was then followed through by upside in volatility. And as momentum pushed lower and lower, volatility just continued to push up and push up. Basically giving very good signals of how far the markets might be able to fall, obviously with a couple of inputs that we watch. So what do we have here? We basically just have an RSI with a standard 14-day look back period to basically track price momentum. And we've also added the VIX, which will be the volatility gauge, on top of that, and inverted the VIX so that we can see a tracking momentum. Because remember, the VIX normally moves inversely to the S&P. So when the S&P goes down, you expect the VIX to go up. In this case, we've just inverted it so that it tracks price momentum to give us a cleaner signal. If we didn't do that, it can still work, but that just looks a little bit less clear compared to just tracking volatility, using it to track momentum. Now, I've already had quite a few people asking, what about the period, the 14 period we use for the RSI? Could there be a different one? Should we be looking at different ways to measure it? To be honest, guys, I think overcomplicating it by trying to find, the type of holy grail look back period, I do think things like that is a waste of time. We just want to track momentum, right? Whether it's rolling over or whether it's decelerating or accelerating, basically. And I think the 14 period does a pretty good job at that already. So I'm just going to stick with that. But of course, if you guys feel that you can improve on it further by experimenting a little bit with different RSI periods, have at it. And if you guys do find a period that seems to work a little bit better, then please obviously let us know about that. Now, to make the signal we get from this a little bit more effective, we want a couple of things to fall in place. We basically want to see price at a local top, or obviously a local bottom if we're looking to buy. And for that, also to be the case for volatility in the VIX. So we want price to be close to recent highs while the volatility is close to recent lows. And then we want to look for signs that momentum is breaking down lower or breaking to the upside. And the idea, again, is that momentum leads volatility, or volatility follows momentum. So if we can see momentum starting to break down, especially breaking through that MA, that moving average, we would expect volatility to follow it. It's really, really simple to understand. It's easy to follow. And that's what I like the most about it. Now, let me quickly explain how we set this up. I'm just going to delete this to show you guys from scratch how we do it. So just start with a normal equity chart, the S&P, and then just go to indicators. And again, I'm just using the basic relative strength index. And when I use that one, the standard one, it already gives me the MA. It already puts it in with a 14, the standard 14 periods. I didn't change anything on that. Really simple. And then we want to add in the VIX. Now for that, we can just go to compare or add symbol. I'm going to pop in the VIX. And you guys can see here, I'm just going to say new price scale. Now this one obviously adds it to the S&P chart. Now if you want to add that to the RSI chart, just find anywhere on this VIX, just right click on it. And then you can see move to, just scroll down to move to, and then say existing pane below. When you do that, it obviously populates it on top of that. And then you can just go here to the left-hand side, right click on it, and just invert that scale. And now you can see it's exactly the one we are looking at. And I just changed that to white to give me a little bit more of a cleaner look. So that's how easy it is to set it up. So let's get into the meat of this and look at a couple of examples. Now, if we just take a look at these big recent sell-offs that we've had in equity markets, which basically followed the big bear market rally that we had. If we take a look at this one, for example, the big sell-off there, we take a look at this one over here, and if we take a look at this most recent one, we can find some pretty good patterns in this. So again, we want to see momentum breaking down and volatility expected to follow that. So in this case, keep in mind that when momentum breaks down and volatility moves lower, it's actually moving up, right? So we're looking at an inverted VIX here, which is very important to keep in mind. But just look at how simple this is, right? We have price moving to the upside, pushing to the upside. So we're getting very close to recent highs, a recent local top. Then we have momentum breaking down below the moving average. And as that starts to push lower, we see momentum or see volatility following that. Now, what's useful about this is that momentum moves first, and then we see volatility following. And when this signal is even more powerful, again, is when we have price at a local top and the volatility at a local bottom. So here we can see that price was trading close to a local top. And over here, we were seeing volatility trading close to recent bottoms, because remember, this is volatility or VIX inverted. So we have price at the highs, we have volatility at recent lows, momentum breaks down, and volatility follows it lower. Let's take a look at this example over here. We basically have price pushing up towards recent highs, which is that high going back to the 28th, the high going back to the 25th. We have volatility breaking down, or a momentum breaking down below the moving average. And take a look over here. We have a high in the VIX, a high in the VIX, and now another high in the VIX. So we're trading the VIX, low in the VIX rather, because it's inverted. We can see that it's trading close to recent lows. Very similar to this one over here that we've had more recently. We have price trading very close to a recent top. We have momentum breaking down below the moving average, and then we have volatility following alongside that. So a really, really simple signal that we can use. Now, just like any other signal, it's not going to be perfect. There's going to be times when it might not work as well. There might be many different reasons for it, but very simple but effective way for looking at potential inflection points in equity markets that we can use to our advantage by just using two very simple things that everybody has access to, which is momentum and obviously something like the VIX. Now, with all of that out of the way, there is another way that we can make this signal even more effective, and that is by knowing what the underlying risk sentiment is in the markets. So, for example, if we are in a medium-term bear market or a bull market, that will change what type of signals we'll be looking for these types of patterns, right? This might seem like a trivial point, but it's actually quite helpful to distinguish between an underlying bear and an underlying bull market, because whichever one you're in right now, that will give us a sense of where the biggest flow, or let's say the biggest volume, will come into the markets. So if you want the biggest bang for your buck, you want to be trading in line with the biggest momentum, the biggest volume in the market. So when you know that you are in a bear market, that means that your biggest impulsive moves is going to come from bearish moves, from downside moves. And when you're in an underlying bull market, it means that your biggest volume, your biggest impulsive moves is going to come from rallies. So when you're in a bear market like the one we're in right now, you're going to favor to sell the rallies. Basically, you're going to wait for those rips to the upside, and you can use something like this to signal when momentum breaks down, to potentially give you a trigger to get in to the downside and basically follow that move lower. When we are, a couple of months down the line and we are back inside a bull market, we would favor to trade the other way around, right? Then we would look to wait for any dips, and we'll use volatility or momentum as it breaks above, breaking back above the MA. We would expect volatility to follow it lower, and obviously that can give us great entries. So I would prefer that, as opposed to just using this as every type of directional trade, because again, you want to be moving in line with the big players in the market. You don't want to be, without good reason, you don't want to be trading against them. You want to be trading in line with them as much as possible. And that means in a bear market, you would favor selling any rips when that momentum breaks lower. And in a bull market, you would favor buying any dips when that momentum breaks back to the upside. So just a quick video on why we use this, why it's useful, and a quick example of how you guys can set it up on the charts.